A few months ago, I started this challenge with a $10,000 lump sum and committed to steadily building it into a 100k stock portfolio. Up until now, I've been adding cash regularly, especially when the market pulled back during the tariff dip, and now the portfolio is sitting at around $28,000, with about $2,400 in unrealized gains, or roughly plus 10% in just a few months. In today's video, I will be giving you guys a full breakdown of my positions that I have currently, all 10 of them from highest value to lowest. These are high conviction, high growth stocks, which I believe can compound hard through 2025 and beyond. Let's jump right into it. Let's start with my biggest position currently, which is Amazon. Amazon is my biggest position for a good reason, because I think this company is a true monster. If we take a look at total revenue, we can start to understand why I think Amazon is a true beast. They pulled in $638 billion in total revenue last year, growing 11% year over year. That's with them just scratching the surface internationally. They have their cloud arm, AWS, which is continuing to dominate the cloud space, and the cash flow it generates allows them to keep investing in other segments of the business, which are all scalable and high margin. Think of things like AI, logistics, but also their advertising business, which is right now booming. Beyond just scale, Amazon's biggest advantage is its logistics and distribution mode. Amazon right now is also innovating in that front because they have more than 750,000 robots that sort, lift, and carry packages. No one ships faster or more efficiently than Amazon. Their ad business is now one of the fastest growing in the world. It's high margin and highly profitable. Pair that with AWS being the backbone of the internet, and you have a business firing on multiple engines. Meanwhile, the forward PE is trading around all-time lows at 33 currently, which is very, very cheap for a business of this scale with the current growth rate. They've proven they can cut costs when needed and scale profitably when the opportunity occurs. Long term, I see Amazon as a compounder with multiple engines that are all firing at high speeds. They are all profitable and growing at double digits. They have cloud, ads, e-commerce, and now also AI, so I will keep adding this stock on dips. Meta is up next, and honestly, it's still one of the best value plays in big tech. So Meta did $164 billion in total revenue last year, which is up 21% year over year, and they're currently trading at a forward PE of around 26. Historically speaking, it is a cheap valuation in my opinion, especially if we look at the total revenue growth which occurs the last few years and the upcoming AI boom. So Meta is really great value for a company with this kind of profitability and growth. They're also turning into a cash flow monster currently, and they're doing it while reinvesting heavily in infrastructure and AI. Their cost discipline has improved dramatically over the years, and they've shown that they can monetize attention better than anyone else. They've built the rails for the attention economy, and their ad business is really firing on all cylinders again. Reels is exploding and monetizing better than expected, and they're quietly becoming a major AI player with massive infrastructure investments. Plus, Reality Labs is a long-term bet that could still pay off. I like the risk-reward profile here for Meta. They are insanely profitable, still innovating, the price is attractive, and I think the revenue will explode over the coming years. Next up, we have another large position in my portfolio, which is Netflix. Netflix is currently getting more expensive at this point, but I still hold it for its resilience and long-term margin expansion, which is expected the coming 5 to 10 years. Netflix reported total revenue of $39 billion last year with 50% year-over-year growth, trading at a forward PE currently of around 46. So yes, historically it is getting a little bit pricey, but Netflix is a cash generating machine right now. If we take a look at some of the fundamentals, we can start to understand why that is. Netflix is quietly becoming one of the most profitable content businesses ever built. They have global reach combined with original IP, which means they own both the platform and the content, which is a rarity in this business. And the new ad-supported model gives them another monetization lever that's still early in the rollout. The ad-supported tier and password crackdown both boosted subs and revenue, and they're expanding globally into new content and IP licensing. What I like most is how they are building a moat through original content and platform control. Netflix is still a unique streaming play that's growing and, more importantly, profitable. Next up is Google, which is currently the most underpriced of all the tech giants in my personal opinion. If we take a look at the numbers, we can start to understand why, because they brought in $350 billion in revenue, which is up 13% year over year, while trading at a historical low 4 PE of just 17. That's really dirt cheap for a company with this kind of dominance in multiple segments, while also being super profitable. And even though AI is certainly a risk, Google still has 90% market share in global search, give or take, and that dominance continues to print cash. We've seen that also in the Q1 numbers of 2025. We didn't see a change, we still saw growth, so the numbers are really saying the facts right now. YouTube is still a core growth driver as well, with shorts keeping them relevant with younger users. And don't forget Google Cloud, which is now finally profitable and growing insanely fast. So we have YouTube, we have search, we have Google Cloud, and now also AI tools like Gemini. They are firing on multiple fronts. Google Cloud is growing fast and finally operating at a profit. YouTube Shorts is competing directly with TikTok, and we have Google Gemini, which is now competing with ChatGPT. It is very rare to find a mega cap stock which is growing this consistently with such a low multiple. I'm happy to keep holding and adding to the position. One recent addition to the portfolio has been AMD, which is currently my favorite high upside chip stock. They're currently doing $25.7 billion in total revenue, which is up 13% year over year, while trading at a 4 PE of around 32, which I still think is undervalued given what's coming in AI and the growth that we're seeing in data centers, which is showing a revenue increase year over year of around 55%, which is absolutely huge. AMD is now Nvidia's biggest threat, not just in CPUs, but also in AI and data centers. Their new chips are a direct challenge to the dominance that Nvidia has had the past few years, and demand is ramping up, as we can see from the numbers. They're now leaner, more innovative, and also gaining share across multiple verticals. AMD's new MI300 chips are starting to gain traction. They're pushing harder into AI GPUs with their upcoming MI400X, which is going to be a very solid contender versus the Nvidia chips. And I believe that AMD's growth path is pretty clear. They need to try and dominate in AI with their new chips. They need to continue to gain market share in data centers and gaming and drive margins up. I'm holding this one with conviction for the coming time. Now let's talk a little bit about finance and fintech, starting with Mastercard. Mastercard posted about $28 billion in revenue last year, which is up about 12% year over year. And it's currently trading at a 4 PE of roughly 33, which I'd call fair currently, considering the consistency of the company, but they also have some growth perspective left. Mastercard processes billions of transactions daily with huge exposure to international and cross-border flows. Their network effect is truly unmatched. Only Visa comes close, together with a few others, but really the dominance is just from Mastercard and Visa. And they benefit every time someone uses a card anywhere in the world. Mastercard has an incredibly wide moat, global reach, and is benefiting directly from the secular shift towards cashless payments. Cross-border volume is rising again, and they're investing in new technologies like tokenization and real-time payments. And while you might think that Mastercard is not really a tech company, the innovation that they are implementing in their business, but also in the sector, is proving otherwise. I see Mastercard as a lower volatility compounder, which is kind of balancing out my other higher placed position names. It's not going to double in a year, but it'll grind steadily higher for decades to come, which is reliable. Then we also have Visa in the portfolio. I kind of split my money between the two of them because I think they are both great companies. And I think Visa is slightly cheaper on a forward basis, while Mastercard might have more growth perspective. And most of the times, Mastercard and Visa move together. So the trends that we're seeing will be similar in both stocks. For Visa, they did $36 billion in revenue last year, which is up about 10% year over year, and it's currently trading at a 4 PE of 26. And it might be hard to believe, but Visa is even bigger than Mastercard. They have a wider moat and slightly stronger operating margins. Their network spans across 200 countries and counting, and they make money with zero credit risk. Their scale is truly unmatched in the industry and also across other industries. They are growing in digital wallets, embedded finance, cross-border payments, and every swipe, tap, or online checkout flows through their system. Visa is now also pushing into sectors such as embedded finance, building partnerships with fintechs, and trying to tokenize assets via stablecoins. This is a rock solid hold for me. Same like Mastercard, it has lower risk, but it will give consistent gains in the market. They have consistent cash flows, and they will quietly compound in the background. Microsoft needs no introduction. It's the most well-rounded growth stock in the world, in my opinion. Microsoft did about $245 billion in revenue last year, growing about 15% year over year. They are currently trading at a 4 PE of roughly 33, which is getting closer to fair value, but I still think it's worth a buy in my opinion. And the beauty about Microsoft's business is that it's so diversified. They have Azure, they have Office, they have LinkedIn, they have Xbox, and now also different AI verticals. But Azure is really the star of the business currently, which is growing 30% annually and now competing directly with AWS in cloud and also AI services. Their Copilot integration is a genius move, embedding AI into software that's already mission critical, and Microsoft continues to be the enterprise software leader. Microsoft's Copilot integration into its software is really genius. It's embedding AI into software which is used by enterprises already. Microsoft has also proven to be a cash flow machine with exposure to cloud, AI, software, gaming, all massive markets really. And this is a core holding which I want to add to the position and I don't plan to touch in the meantime. Last but not least is Robinhood. It's my smallest position, but it has proven to be the best one as it has shown the highest percentage gain of all stocks so far. And Robinhood posted about $3 billion in revenue last year, which is up a massive 58% year over year, while trading at a 4 PE currently of around 60, which is fair given the growth outlook. Now, we all know Robinhood as kind of a meme stock or a stock that you wouldn't take seriously, but over the years, Robinhood has grown into a highly profitable, growing business. It's no longer just a trading app, it's becoming a full financial ecosystem. Their user base is sticky, they are launching new products which are subscription based, such as gold, retirement, and even mortgage products. And if they pull off their international expansion, which is now planned for the UK and EU, this stock could re-rate very, very fast. If we see a dip, I plan on adding to Robinhood as well. So that's the full breakdown of my portfolio. Currently, we have $28,000 invested across 9 high conviction positions with about a 10% gain in just a few months. I'm aiming to hit roughly 100k by the end of 25 by adding cash and also making some gains on the positions. I'll keep adding to the portfolio regularly, especially during volatility, and the focus stays the same really. We have long-term compounders with real growth, real revenue, and strong fundamentals. If you're enjoying the journey and enjoy this type of content, make sure to like the video, subscribe, and drop a comment with your top pick right now. Thanks for watching everybody, and let's keep building. See you guys in the next one.